Hello everyone, my name is Rebecca Ayang Anak Georgie and welcome to our video presentation. Me and my group members are going to advise RSP Sendirian Berhad on tax planning opportunities to reduce tax liabilities. Without further ado, let's take a quick look on my group members. Alright, let's start. A. Choose the best option between ITA or pioneer status. So RSP Sendirian Berhad is a newly manufacturing company that participates in a promoted activity or produces a promoted products. Pioneer status is given by way of exemption from chargeable income tax on 70% of statutory income for 5 years, and the remaining 30% is taxed at the prevailing chargeable income rate. ITA is granted on 60% qualifying capital expenditure incurred for a period of 5 years and is utilized against 70% of statutory income, while the 30% balance is taxed at the prevailing chargeable income rate. So, RSP should not apply for pioneer status because RSP pioneer activity is capital intensive, which means that the company requires a large amount of investment to produce a product and thus have a high percentage of fixed assets such as property, plant and equipment (PPE). It also incurs losses in the result in a substantial capital allowance claim and a lower amount of tax-exempt income. Therefore, RSP should apply for ITA because the pioneer activity is capital intensive and the losses can be carried forward until the exemption period until RSP become profitable in the 5th year assessment 2021.
Hello, my name is Nurhanani Ahmad and I will talk about the commencement of business minimize non-allowable expenses. Date of commencement is crucial in determining a basis period for this business. Generally, the expenses incurred before the commencement of a business is not deductible. It is also should not incurred wholly and exclusively in the production of gross income. These expenses were incurred in the preparation of opening the business. When a manufacturing company begins manufacture of its finished product, it marks the official commencement of operations because these expenditures are not only used only to generate gross income, because they are not deductible. Our SP Sendirian Berhad will be unable to deduct them from its taxable income. TSV Sendirian Berhad and Inara Sendirian Berhad have both recorded losses for the current year loss. As a result, the company's loss may be carried forward and used to offset any business revenue in future years. Top Sendirian Berhad capital's allowance must be reduced from the company's adjusted income to reach at statutory income. Prior to the commencement of the business, the company incur an expense for purchasing raw material which is not deductible since it was not incurred wholly and exclusively in the production of gross income, and they can claim the capital allowance when the business starts. As a result, the company should reduce the expenses that are not allowable, such as expense for raw material, which are not deductible.
So, for the assets that are not qualified under ITA, for example, motor vehicle, RSP Sendirian Berhad are given two methods on how to acquire that asset. First is outright purchase asset and leasing method. For the outright purchase, the claim of capital allowance is based on full qualifying expenditure (QE), except passenger vehicle, whereby the QE is restricted to 50,000 and 100,000. For the first year of claim, the company can claim initial allowance and annual allowance, and for the subsequent year, the company can claim annual allowance until fully utilized. The capital allowance is deducted from adjusted business income in arriving at statutory business income. The second method is the leasing method. For leasing method, the company is not able to claim capital allowance because the company is not the owner of the asset. But the company is entitled to claim revenue deduction as stated under Section 33 lease rental. For vehicle not licensed for commercial transportation, the lease rental charges is restricted to either 50,000 and 100,000. There are several advantages using leasing method. The first one is timing. A full amount of lease rental deduction is given in the year incurred, whereby the capital allowance is spread back to various years and restricted to specific rate. The second advantage is about the set-off and utilization. So for lessee, they are able to recover the full cost of leasing in a shorter period as compared of claiming of capital allowance. Lease rental expense either increases business loss, which is the current business loss, or reduce business income. In a case where a current year business loss is attained, the amount is allowed to shelter other income at the aggregate income level. If aggregate income is insufficient, the excess business loss is allowed to shelter other business income at statutory business income level in the following year. So for comparison, the claim of capital allowance is restricted to the respective business source. If adjusted business income is insufficient, capital allowance can be carried forward to the future year. However, unabsorbed capital allowance is only allowed to be set off against the particular business source in future year of assessment. Therefore, for tax planning purposes, it is preferable to use the method which has a favorable effect, which can reduce taxable income and reduce tax liability. Most of the companies prefer lease rental because it does not involve cash outlay upfront. So, RSP Sdn Bhd should acquire the asset through leasing method.
Hello, my name is Valentin Anadiana and I will explain about interest restriction. Under Section 31(1)(a), interest expense is allowable as a business deduction if the money borrowed have been either employed in the production of gross business income and laid out on assets used or held for the production of gross business income. The deductibility of interest expense on money borrowed may be subjected to interest restrictions which apply to loan for non-business purposes or has been used for investment purposes. Interest on loan related to investment purposes is not allowable as a deduction under business income, Section 4A, but allowable under investment income, Section 4C. So in this case, the investment income received by RSP will be subjected to interest restriction because it is non-business related. Although the amount of the interest expense is deductible against interest income from investment income, it will be subjected to a maximum deduction of the investment income, and the remaining interest expense will be disregarded if the income is not sufficient. Therefore, RSP should use the borrowed money more for the business purposes and less for the non-business purposes in order to reduce the tax liability, because the interest expense related to business is deductible from the gross business income and it is not subjected to interest restrictions, while the interest expense related to non-business is deductible against interest income from investment income, which will be subjected to interest restrictions, and the remaining interest expense will be disregarded if the income is not sufficient. Other than that, RSP also can increase the interest charge a little bit to TSB so that the tax liability can be minimized.
Talking about tax planning on disposal fixed asset. Based on the disposal of fixed assets, RSP Sdn Bhd has yet decide whether to dispose these assets to its loss-making subsidiary INARA Sdn Bhd or to unrelated entities. This is referred to as controlled transfer. Because RSP owns more than 50% of INARA Sdn Bhd, the controlled sale provisions would apply because the acquirer, INARA Sdn Bhd, is a person over which the disposer, RSP Sdn Bhd, has control. The tax authority is authorized to claw back capital allowance and treat it as a balancing charge in the year of disposal. A minimum required of 2 years of ownership is required to avoid capital allowance clawback. The regulated transfer clause will deem the transferred asset of tax return down values of the transferor. As a result, the transferor will incur no balancing charge or allowance. The subsidiary, INARA, is nevertheless entitled to an annual allowance based on the asset's initial acquisition cost. In short, the transferred control will usually favor the acquirer, RSP Sdn Bhd. Since INARA is expected to lose RM at 100,000 per year from year of assessment 2019 to year of assessment 2021, RSP can use the losses to offset the balancing fee due to high resale value rather than selling it to unrelated companies. Because the companies receive a large balancing charge, it may increase its chargeable income, and as a result, they need to pay more tax. Thus, RSP should dispose the machines to its subsidiary, INARA Sdn Bhd.
Group relief is a practice of allowing current business losses incurred by one company within a group to be deducted against profit from another company within the same group. A company qualifies may surrender a maximum of 70% of its adjusted loss for year of assessment to one or more related company, and the claimant company may claim adjusted loss more than one surrendering company. In this case, RSP Sdn Bhd is a resident company with paid-up capital more than 2.5 million, has forecast minor losses in the first year of operation, which is from year 2017 to year 2020. RSP Sdn Bhd has 3 subsidiaries, which is TSB Sdn Bhd, INARA Sdn Bhd, and TOP Sdn Bhd, which possible to be the claimant for the losses. Only INARA Sdn Bhd and TOP Sdn Bhd had met a requirement of 70% shareholding. However, INARA Sdn Bhd is suffering loss of 800,000 annually from 2019 to 2021. Meanwhile, TOP Sdn Bhd is expected to have aggregate income approximately 1 million per annum from year 2019 and onwards. Thus, only TOP Sdn Bhd is eligible to be claimant company as the company has fulfilled the conditions. Therefore, RSP Sdn Bhd is eligible to surrender its 70% of the business loss to related company, which is TOP Sdn Bhd. The group relief will reduce the tax liabilities by deducting RSP Sdn Bhd losses with aggregate income of TOP Sdn Bhd.